Hi, welcome back to the second video in the fifth lecture of Covidenomics. And it's time for a detour. In this detour, we're going to be talking about the concept of a real option. An option is generally thought of as a sort of financial contract, but a real option is slightly different. It arises in situations where you can make an investment or a decision that's got real costs. That decision has to involve sunk costs. So you're going to be making a commitment, a costly commitment, that is unrecoverable. So unlike a fixed cost, which you can get back if you stop production or you stop your operations, a sunk cost is something you cannot get back. No matter what you do, it's gone. So it's an investment that involves a sunk cost, and there's got to be uncertainty. There's uncertainty about whether the investment is going to be good or a poor investment in the future. And the final thing you need for a real option is that uncertainty needs to be at least partially resolved over time. And the option is the option of waiting, not making the decision and the investment today, and waiting until that uncertainty is at least partially resolved before deciding whether or not to invest. And the existence of that option can mean that even though it looks like investment today is profitable, it can be even more profitable not to invest today and wait, even though potentially waiting will mean you never invest. Let's see what we mean. We're going to use a simple example to illustrate the idea of a real option. So, I'm going to face an investment. The investment is going to cost me $100. I can make that investment today. Once the investment is made, however, the $100 is sunk. There's nothing I can do to get it back. It's simply gone. The investment is going to give me payoffs over a period of 2 years, and it's going to be a risky investment. While the investment is going to pay off $60 for sure this year, next year it will either pay off $200, which has a 50% or a 1/2 probability, but it may lose $100 next year. And that will also occur with a 50% probability. Let's just stop here for a second and ask our first question. Would we want to do this investment? In other words, does it have a positive net present value? For simplicity, let's assume a zero interest rate so that we don't have to discount next year's dollars back to this year's dollars. And in that case, the net present value is positive. How do we see that? Well, we have the minus 100 initial investment, but we know we're going to get 60 back this year, so that's minus 40. Then next year, we're either going to get a half chance of 200, so a half times 200 is 100, but we may lose 100. That's got a 50% probability. So that's a minus 50. So 100 minus 50, so that's $50 next year. We've got a minus 40 this year, plus 50 next year. That gives $1.10 overall as the net present value. So this is a desirable investment. If we invest today, we're going to get more than our opportunity cost. Would we do that? Well, the answer is it depends. Let me add a bit more detail to this example. Suppose that we have an option. It's the option of waiting until the end of the year to invest rather than investing today. Well, if that's all that we've got, that sounds like a pretty silly thing, because then all we'd be doing is missing out on this $60. If we invested next year, we'd spend $100, half chance of 200, half chance of losing 100. That would mean that we're now in an undesirable situation. So why would we wait for a year before investing when that's going to cost us $60? The answer is that waiting may be a good idea if we're able to get some payoff relevant information. For example, suppose that if we wait for the year, we actually get more information about whether this is a good or a bad investment, so that when we decide to whether or not to invest at the end of the year, we will know whether it's a good investment and going to pay off $200 in that second year, or a bad investment and going to lose $100 in the second year. Is it then a good idea to forego the $60 and wait and get that information? Notice that the information is payoff relevant, i.e. it tells us more about the investment. Second, notice that after we get the information, we of course have the option not to invest. And if we know that it's a bad investment, we're not going to put our $100 into it. And that's going to change the payoffs. So now we've got two net present values. Here's the net present value if we invest today. We've worked that out, that's $10. But here's the net present value if we wait. If we wait, well, with a 50% chance, it's going to be a good investment. If it's a good investment, we're going to say, ripper, let's go for it. We're going to invest our $100 as a sunk cost, and we know we're going to get $200 back because it's a good investment. But there's also a 50% chance that we'll find out it's a bad investment, in which case we'll say, we're not going to spend our money, we'll just keep our $100. So with a 50% chance, we'll end up getting nothing. We won't spend the $100 and we won't lose the $100. The overall net present value, when you calculate this, is simply $50. But notice that the $50 is more than the $10. In other words, this investment is worth more if we don't invest today, we give up the $60 return this year, and we wait until we get more information. Because the payoff relevant information means that we can act differently after we've got that information. We can wait. We don't have to sink our investment capital today. We can wait until we get the information. Then, if we want to, we can make the sunk investment. So the idea of a real option is that we can wait and not make an irreversible or a sunk investment. We can wait, and if we get some payoff relevant information, that can allow us to make a better decision in the future. And that is valuable. In this situation, the real option is worth $40. If we invest today, the NPV is 10. If we wait, we get an extra $40 of value. The NPV is 50. Or another way of thinking about this is that if we invest today, there's an opportunity cost. We forego the ability to wait and get more information. That opportunity cost is $50. So that if we correctly calculate the NPV today, it's actually minus $40. In other words, if we invest today, we make the irreversible decision, we put our $100 into the investment, we get $60 this year, we get a half chance of $200 next year, but also a half chance of losing $100 next year. But we also give up the option of waiting when we invest $100 today because it's irreversible. It's a sunk investment. But the NPV of waiting, well, that's worth $50. So the opportunity cost of investing today is giving up the $50 associated with waiting. And when we put that loss of $50 in, that cost, the NPV of investing today is actually minus $40. We don't want to invest today. We want to wait, get more information, and make a better decision tomorrow. So why have we taken this detour? Well, because when the government in March is trying to work out its strategy for COVID-19, it actually faces one of these real options. If the government chooses a soft lockdown, then that is pretty much irreversible. It will lead to an increase in the number of COVID cases in the community. The virus will be able to spread, and we've seen from our modelling that once it starts to spread, it becomes much harder to pull it back. So if you do a soft lockdown, that increases the case numbers, and in a sense you're going to be stuck with increased case numbers forever. In contrast, if you do a hard lockdown, then later on, say in May, you can always soften the lockdown. You can always ease the restrictions and let the virus take off a little bit more. So In a sense, a hard lockdown gives you the option of later on softening the lockdown and letting the virus have a bit more movement through the society. But if you start with a soft lockdown, in a sense you're giving up that opportunity to crush the virus. So, in many ways, it's just like this real option example here. The government must make a decision in March based on imperfect information, but it does have the ability to lock down hard and gain more information to make a better decision in May. And if it doesn't lock down hard today, it's too late by the time it gets to May. Finally, here's our game tree for this real option investment. At t equals 0, that's the start of this year, we have a decision to make. We can either invest or we can wait. If we invest, sunk investment, can't recover it, we let it run, we know that's got a net present value of $10 or an expected payoff of $10. What about if we wait? Well, if we wait, then nature is going to have a move. It's going to flip the coin. If it comes up heads, nature says the investment's good. If it comes up tails, the investment's bad. And we learn that. So we get this information. We know where we are on this game tree. Now, if it's a good investment, then at the end of the year or the start of the second year, we can make the investment. If we make the investment, then we get a payoff of $100. We put $100 into the investment, we get a $200 return, a net return of plus $100. Or we can not invest and just walk away with zero. If it's a bad investment, well, at the start of a year, we can still invest, but if we invest now, we spend $100, we know we're going to lose $100, so if we invest, we know we're going to lose $200. If we stop, we know we're going to make zero again. Now, this is a pretty simple game now, but let's solve it. Let's first off consider that nature's got a bad draw. We've got a bad investment here. What will we do? Well, it's pretty clear when we get down to this point, our choice is either to invest and lose $200 or stop and lose nothing. Well, in that case, we're going to prefer to stop, so we can wipe out that branch of our decision tree. We're just again using this backward iteration or sub-game perfection to solve the game backwards. What about if nature's done a good draw? Well, then when we have the option at the beginning of next year of investing, we can either invest and get 100 or stop and get zero. Well, in this situation, we prefer $100 to nothing, so we're going to choose to invest. So what's our game look like now? Well, our game now can be simplified, and that's what we've done here. So we know that if nature chooses a good investment, we're going to get $100 because we'll invest. If nature chooses a bad investment, we'll just simply stop and get zero. But now we can bring that back again, recognising that good has a probability of a half, bad has a probability of a half. So our expected payoff if we wait is simply given by $50. So our game is really simple now. We can either wait and get information, the expected payoff is 50, or we can choose to invest at the beginning of the first year, and our payoff is 10. It's clear here that we're better off to wait. We're better off to wait because we're in a situation with a real option where some payoff relevant information will become due over time. We can put off making a sunk investment until we get that information, and then we can make a better decision given we've got that information. Okay, back to COVID-19, back to thinking about this from the government's perspective in February or March 2020. Do that next time.